Michigan to Minnesota, the quiet collapse no one saw coming.
In 2025, something subtle but significant is happening between two of the world's closest trade partners, Canada and the United States.
What was once a seamless economic relationship is now showing deep cracks, not from a crisis, but from a quiet, persistent shift. This isn't the story of sanctions or tariffs.
It's the story of a silent boycott, a growing Canadian pullback that's slowly but steadily shaking the economic foundations of several U.S. states.
Let's start with Michigan.
For years, Michigan's economy has thrived on its strong relationship with Canada. Over $27 billion worth of goods are exported north each year, much of it tied to the auto sector, agriculture, and raw materials.
But in 2025, that number is slipping fast.
Canadian trade volume is down more than 12%. In cities like Port Huron and Sault Ste. Marie, local businesses are feeling it. Gift shops, gas stations, pharmacies, and restaurants report fewer Canadian customers and falling revenues. The auto industry, especially in Detroit, is facing a new wave of uncertainty. Once hailed as a symbol of America's industrial comeback, Detroit's resurgence relied heavily on Canadian investment in cross-border manufacturing. But as Canadian plants look elsewhere for parts and partnerships, Detroit's fragile gains are at risk. Automakers are diversifying their supply chains, but these adjustments take time and they come at a cost.
Indiana is next, and the impact there may be even more severe. Canada is Indiana's largest international trading partner. Nearly $12 billion in goods move north each year. But now, orders are being cancelled. Trade volumes are down by over 9% just in the first quarter of 2025. In towns like Elkhart, Muncie, and Terre Haute, manufacturing plants tied to Canadian contracts are cutting shifts, delaying projects, and in some cases, laying off workers. The state's agricultural sector is also under strain.
Corn, soybeans, and pork producers are seeing lower demand from Canadian buyers. Some are trying to pivot toward Mexico or other markets, but at reduced margins. Local grain cooperatives report unsold stock, and pork processors are taking financial hits. Behind closed doors, Indiana officials are already lobbying for trade relief, but public trust across the border has eroded.
Illinois, a giant in U.S. manufacturing and agriculture, is also showing signs of stress. Canada accounts for over 25% of Illinois' international trade, over $16 billion annually. But shipments are down.
Manufacturing hubs like Peoria, Decatur, and Rockford are reporting reduced orders. Some Canadian firms are renegotiating contracts, citing political tension and trade uncertainty. Others are sourcing from states with fewer perceived risks or skipping U.S. suppliers altogether.
Illinois farmers are also feeling the pinch. Corn and soy exports to Canada have dropped more than 13%.
In farming communities like Bloomington and Quincy, grain elevators are operating below capacity.
Logistics firms are moving fewer loads across the border. The Port of Chicago is reporting reduced container volume to Ontario and Quebec. All this is happening as inflation pressures mount and local governments struggle with declining tax revenue and rising costs. But perhaps the most vulnerable is Minnesota. A calm and steady state by reputation, Minnesota's economy is deeply tied to Canada, its largest international trading partner.
In 2024 alone, the state exported over $11 billion in goods, including medical devices, farm produce, and industrial machinery.
But now, that trade is retreating.
Small and mid-sized manufacturers in Rochester, Duluth, and St. Cloud are scaling back production.
Some workers are being shifted to part-time. Others are facing
layoffs. Minnesota's farmers are seeing fewer Canadian buyers for wheat, soybeans, and pork.
Rail and trucking volume is slipping. Grain elevators are holding more inventory than they can sell.
Even the Port of Duluth, once a vibrant hub for cross-lake trade with Canada, is shipping less northward. Local communities are beginning to notice slower business, shorter hours, and quieter tourist seasons.
This isn't a crash. It's erosion.
A slow-motion unraveling of trust in trade that's hard to quantify, but impossible to ignore.
And the most dangerous part? It's happening silently. There's no big announcement. Just fewer orders. Cancelled contracts. one small exit at a time.
Across all these states, the story is the same: decades of tight cross-border economic ties are being strained by politics, by consumer sentiment, and by shifting priorities. It's not a collapse, but it could lead to something just as damaging: a silent recession, one that creeps in unnoticed until the damage is done. So the question isn't if this matters, it's how much longer we can afford to ignore it.